Long before the invention of banks or coins, people engaged in direct trade, exchanging goods like wheat for livestock or tools for cloth. However, this barter system had its limitations. Imagine needing shoes but having only grain to offer, while the shoemaker had no interest in grain. To solve this, humans turned to commodity money, items universally valued such as salt, shells, cattle, and even beads. Around 600 BCE in Lydia, which is modern-day Turkey, the first metal coins were minted from electrum, a natural blend of gold and silver. These coins were portable, durable, and standardized, making them a revolutionary development. The concept of coinage quickly spread, laying the groundwork for future monetary systems. Coins, though revolutionary, were cumbersome. In 7th century China, merchants began using promissory notes, written promises to pay later. By the 11th century, the Song Dynasty issued the world's first government-backed paper money, a significant leap forward in monetary history. Meanwhile, in medieval Europe, Italian bankers, such as the Medici, utilized ledgers and credit to facilitate trade. These early banks held deposits, made loans, and even transferred funds across cities. The term bank originates from the Italian word banca, meaning bench, referring to the tables where moneylenders conducted their business. This era marked the beginning of a more sophisticated financial system, paving the way for modern banking practices. As global trade expanded, so did the demand for secure and stable money. In 1609, the Bank of Amsterdam emerged as one of the first true central banks, stabilizing currency by issuing notes backed by real silver. This innovation was followed by the establishment of the Bank of England in 1694, created to fund wars. It pioneered fractional reserve banking, a system where banks lend more money than they physically hold. This marked the birth of modern finance, introducing central banks, national currencies, and government debt. These developments laid the foundation for the complex financial systems we rely on today, transforming how money was managed and utilized globally. For centuries, money was tied to precious metals like gold and silver. However, in 1971, the United States ended the gold standard, transitioning to fiat money, currency backed by trust rather than metal. Central banks, such as the Federal Reserve, now manage the money supply, set interest rates, and steer economies. The advent of digital banking, credit cards, and cryptocurrencies has further redefined how we store and move value. Despite these advancements, the core functions of money remain unchanged, facilitating exchange, measuring value, and enabling savings. This era highlights the dynamic nature of money, continually evolving to meet the needs of modern economies. So, what is money? It transcends mere paper or metal. Money is a shared belief, a system built on trust, backed by institutions, and continually evolving with technology. From cattle to coins, gold to algorithms, the history of money is intrinsically linked to the history of humanity. It reflects our collective journey, adapting to our changing needs and technological advancements. As we move forward, the essence of money remains the same, a tool to exchange, measure, and save value. Understanding its history offers insight into its future, reminding us of the profound impact money has on our lives and societies.